Think $100,000 in dividend stocks can make you rich? Let's see what that really looks like. And it's not as glamorous as it sounds. Welcome back to our channel, where we make investing simple and realistic. Today we're unpacking a topic many investors love to dream about: dividend income. Specifically, what kind of income can you really earn from a $100,000 investment? Spoiler alert, it's not quite what you might think. Let's start with the basics. Dividends are portions of a company's profits paid out to shareholders, usually as cash. Sounds great, right? You buy some stocks, sit back, and collect checks while doing nothing. That's the dream of passive income. But let's run the numbers to see how it really plays out. The average dividend yield for solid, reliable companies tends to hover around 4%. So with a $100,000 portfolio, you'd earn about $4,000 per year in dividends. That's roughly $333 per month. Not bad, but hardly enough to quit your job or retire early. And that's before taxes. If your dividends are qualified, they're usually taxed at the capital gains rate, anywhere from 0% to 20%, depending on your income. Let's say you're in the 15% tax bracket. Your $4,000 drops to about $3,400 after taxes. Then consider inflation, which quietly eats away at your purchasing power every year. At around 2% inflation, your real income is closer to $3,300. So while $4,000 may sound like easy money, in reality, it won't cover much more than a few bills or maybe one vacation a year. That doesn't mean dividends are useless. It just means they need to be part of a bigger plan. Here's a smarter move. Instead of spending your dividends right away, reinvest them. When you reinvest, your dividends buy more shares, which then generate more dividends. Over time, this creates a powerful compounding effect, a small snowball that can turn into an avalanche of growth. This strategy can transform $100,000 into something much larger over the long run, but it takes time and patience. There's also risk. Dividend yields can change. A company that's generous today might cut or cancel its payouts during tough times. Think recessions or major financial downturns. That's why it's smart to diversify. Mix dividend-paying stocks with growth stocks, ETFs, or index funds. That way, even if some companies reduce dividends, your portfolio still benefits from capital appreciation. Another tip: focus on dividend growth, not just high yields. Companies that consistently raise their dividends year after year, like those in the Dividend Aristocrats Index, often provide more reliable long-term returns than those with sky-high but unstable payouts. So can you live off dividends from a $100,000 portfolio? Realistically, no. But can you use those dividends to build wealth, create cash flow, and accelerate your path to financial freedom? Absolutely. If you play the long game, reinvest wisely, and stay consistent. In short, dividends are a great tool, but they're not the whole toolbox. Smart investing means balance, patience, and understanding that slow growth often wins the race. Thanks for watching. If this opened your eyes about dividend investing, make sure and hit that notification bell for more straightforward financial insights. Until next time, invest smart and let your money work as hard as you do.